All right, guys, so good morning. Loads of China news dumped on us overnight. Huge wave of data. So this is, of course, the focal point as things get going here in Europe this morning. And we're kind of used to China being the focal point, of course. 2016, I would say basically every single session pretty much has been driven and directed by China. And so this morning's exactly the same. So loads of data to get through. We've got GDP figures for quarter four. Before we get into the nitty gritty of that, let's just cover the other data releases. Lots of data. Here's a few charts. Well, actually, I'll have a look at these charts. Oh no, let me show you the chart. I'm going to show you these charts. Anthony posted these in the room earlier. A few charts. I want to just focus on the bottom left one to start with, and look at the individual data releases for December rather than looking at the GDP figures, which are at the top. I just want to talk about the individual releases that showed December's performance. So here we had industrial production, we had retail sales, and we had fixed asset investment. Now, all the data for December, remember the GDP figures we'll cover in a minute, that's quarter four, so that's October, November, and December. But perhaps more importantly, December's data is a more recent, of course, view, and perhaps a better, it's not a lead indicator, but it's as close to the present as we get. So with this data, it was all marginally disappointing. So the industrial production number for December was year-on-year growth of 5.9%. We'd expected 6%, or sorry, yeah, expected 6%, and that's down from the November reading of 6.2. Fixed asset investment, this also came below expectation at 10.0%. We had expected 10.2, and that's down from 10.2 in November. And then the retail sales number also slightly below. It was 11.1% when we had expected 11.3, and November's was 11.2. All three numbers basically delivering the same message, which was marginally below expectation and a small drop from November. Okay, so this data is bad news, but it's like, it may be, because markets have reacted very positively, and perhaps some of that's due to the GDP figures, but it might be one angle this morning in terms of market reaction, and it was pretty choppy and confused to begin with on Chinese equities, because the Shanghai comp was up about 0.75% before the data. The data hit the news wires and it dropped back to zero. So the initial reaction was negative, and then we had a rebound and actually had a strong session, 2% plus on the Shanghai comp. But the initial reaction was negative because the data was worse than expected. But maybe it's turned into that mindset whereby this news is bad enough to force the authorities' hand in delivering more stimulus. But it's not so bad that, stimulus can't fix it. Maybe that's the kind of mindset of markets off the back of this news. Maybe it's just a bit of pricing in of ever more likely further stimulus from the People's Bank of China. So that's the data, marginally missed expectations for December. But look at the GDP figures. Now here, on the GDP front, it came in also pretty much the same as the December data, and then it was just slightly below expectation at 6.8%. Markets had expected 6.9. Let me take this screenshot off and bring up just a clear bar. See, we had expected 6.9, which was what quarter three was. Now we've got a full set of numbers for 2015, so we've got a full year's growth of 6.9%. And this 6.8 print just for quarter four is the lowest since the financial crisis in 2009. But actually the annualized year-on-year growth of 6.9% is the lowest for 25 years. So we've had an annual growth rate below the crisis year. But this isn't a surprise. So I would say this data All right, so yeah, sorry, I was just talking about the Chinese growth situation. So 6.8% for quarter four. There's two different ways to look at this. Are you an optimist or are you a pessimist? Or maybe there's three ways. Are you just a realist? If you're a pessimist, if you're bearish, you'll look at this and you go, wow, downtrend, worse than expected, worst single quarterly growth figure since 2009, worst annual growth rate for 25 years, batten down the hatches, the world's collapsing. That's the pessimist view. The optimist says, well, actually, you know what? The market's been freaking out all year, and yet here we are. China's grown at 6.8%. And all right, it's just below expectation. But if you take this and actually think about it in monetary terms, then this is powerful growth. Actually, China added, it's basically around about $800 billion to the site. Its economy is well over 10 trillion now. In fact, look at the list of these are the countries in order of size. If you look at the GDP on the left-hand side, the first column, this is in dollar terms, how big is their economies. Okay, as you can see, China's now above 10 trillion. They're the second biggest economy in the world. The US is 17.4 trillion, as you can see here. So growing at 6.8% or indeed 6.9% if you're looking at the 2015 as a whole, growing at that rate when you're this big adds about, well, nearly 8 trillion, nearly $800 billion was added to the Chinese economy last year. Now, check out down the list. That basically means China added about the size of Turkey to its economy in 2015. Actually, just their 2015 growth alone puts them as the 18th biggest economy in the world. The thing is with China, yeah, growth has slowed, and it's slowed dramatically, because if we go back to my chart here, and let's go back 5 years, then growth has gone from 10% down to now below 7%. And sure, growth has gone sharply lower. It's just that actually in dollar terms, it's not changing much. The growth rate each year is lower, but the economy, of course, is bigger. So actually it's still adding easily the most dollars to the global economy than any other country in the world. And so even when we take into account the ever-growing size, surely that offsets the ever-declining growth rate, and actually things are going along fine. The Chinese government is managing this slowdown. This is a soft landing as it stands. And why are markets so freaked out? This is the optimist's view. Which one of those views you take, well, is of course up to you, but they're dramatically different, obviously. Maybe we should just be the realist in the middle. And the realist is, well, look, it's inevitable. China's growth is slowing. They're getting too big to grow at 7%. They're getting too big to grow at 8, 9, 10%. Forget that. They're too mature, even though they're still developing. They're not an emerging economy anymore, so forget 10% growth. Growth is declining. It's inevitable. And it's just a question of how quickly is it declining. And as it stands, this is slow and steady. Now, you could throw in a big dose of skepticism and say, well, is this really the GDP growth figure? Is 6.9% actually true? When you look at a couple of statistics like the fact that steel output actually shrank last year. So in 2015, steel production dropped negative on the year. Electricity output also dropped on the year for the first time in 25 years. These couple of statistics show, well, surely these figures on GDP here surely they're a lot worse than what the government's actually revealing. But you know what? Who knows? All we get is these official figures. Nobody really knows. Well, I'm sure somebody does somewhere. Maybe the Chinese premier, I don't know. But ultimately, this is the official reading. And you know what? It's all right. It's not too bad. And it might be just bad enough to give us more stimulus, but it's not so bad that we should be freaking out about a hard landing. Commodities, just on this topic of China growing, and their growth rate, whilst it's slowing, still means they're adding a similar amount of dollars to their economy each year. Well, you could look at this on the commodity front as well. Here's a couple of charts. Top left, Chinese demand for metals, not in annualized growth rate percentage figures, but actually in dollars. And the point here is we're getting declining percentage annualized growth. But actually in dollar terms, China are still buying more, let's say, copper. They're buying more aluminium. They're buying more nickel every year. Demand is going up. It's just going up not quite as fast as it was. So why have metal prices collapsed 75%? Because demand's really weak. Well, demand's still growing. Isn't this a little bit of an overreaction and a misunderstanding of the fact that China actually are adding a huge amount of growth to the world's economy, more than anybody else, and actually they're buying more metal every year? Okay, it's a slowing rate. I'm sure that's something to factor in, but it's not collapsing growth. It's not collapsing demand. It's not negative demand, which surely that's what commodity markets are pricing in, isn't it? Anyway, just a different angle to think about it. This might be the mindset of markets this morning, because you've got a pretty strong reaction to some of this stuff. Just be careful on some of your, because of the US bank holiday, some of your P&Ls might still be there on your trading platform. Some of the percentage change on your charts might be factoring in yesterday as well. So just bear in mind the US bank holiday yesterday might have just disrupted things. But what we've got here is gap opens at the European Open. The DAX, look on my top right chart, 1.5% up. We're testing a very important price at the moment. We've been testing it all morning, having gapped higher. We're testing yesterday's high. It's key support. Same as the low that we had back on the 11th of January for the DAX, 9,660. Eurostoxx, similar-ish. We are actually sat just below yesterday's high. With the S&P, we've still got a bit of room. We're up around 1,900. Yesterday's high for the bank holiday, where I'm not really going to talk about yesterday at all because it was irrelevant and nothing happened. The bank holiday, 1,890 was the top, and so we're 8.5 points above that on the S&P at the moment. So stocks have opened positively. Look at oil as well. Oil's had a nice punch higher this morning. Again, off a slow and steady bank holiday yesterday, although to begin with, oil dived to a new, multi-year low, but actually then things stabilized and we closed just around 29 bucks on WTI. But look at this morning, up above 30. So actually the commodity space, despite data in China being worse than expected, officially being below expectation, you're actually getting a pretty positive response across the spectrum. Equities, commodities, bonds, because the risk on, I guess, look at the Bund here, has gapped open, gapped lower, but actually we're almost back up to test or to close the gap, I should say, to the closing point from yesterday, which is around about that high point we had on the 14th of January. So bonds trying to just recoup those opening losses. But even though bonds are pretty much closing that gap, equities have not done so yet. So equities still buoyed by these China numbers. With regards to the currency space, you had a little bit of, if we look at the euro dollar, let me just make that chart a little bigger here. We had a little bit of a slip below yesterday's low. This is kind of just after 7 o'clock as Europe woke up and got going, but actually this has been turned around and reversed. So you're actually getting, if anything, right now, you're getting dollar weakness. Maybe, I don't know, it's hard to judge. Maybe this is an inverse correlation to the commodity moves. I'm not sure. I'm looking at the yen. The yen is the weird thing right now. Is the yen is, well, I guess it's weaker on the day, but I'm just looking. keep an eye on the yen. It's been strengthening off its weakness, so it's weakening through Asia. So don't forget, the yen's a good risk barometer, a sentiment barometer. So weak yen through the Asian session, enabling equities to bounce. Now you're just getting that given back. So you're getting a little bit of yen strength right now. When the DAX is sat on yesterday's high, this is quite a critical moment. If the yen continues to strengthen, most likely the DAX will break yesterday's high and try and close this gap. So just keep your eye on the yen here as a lead indicator to see whether this DAX does make a new low and break that opening low or not. Okay, but for now, decent gains, a bit of relief off what's been, of course, a very bad start to the year and a bad end to last week. The DAX down at 9,400 yesterday, as I said, was basically irrelevant. Nothing happened. Let's talk about today then, because no data of any note yesterday because of the US bank holidays. Let me just bring up the data calendar for today. So here we are. Actually, some quite interesting stuff. We've had the China stuff here at the top already, of course. So some interesting stuff this morning. So next up at 9:30, we've got UK CPI data. This is for December. We're expecting it, well, the year-on-year figure to edge marginally higher. So from plus 0.1% in November up to plus 0.2%. The core, we're expecting to remain flat at 1.2. Don't forget, cable has been extraordinarily weak. I should say sterling generally has been very, very, very weak, to say the least. It's been weak for a few months, but particularly over the last 4 weeks, we've just nosedived here. Basically 1,000 pips since, in a month we've gone 1,000 pips to the downside. So very, very weak sterling. This means that the biggest reaction to this inflation news will be if it's better, higher than expected. Okay, this will mean that a lot of this sterling weakness is not valid and that we need to start pricing in a Bank of England rate hike sooner than we currently expect. So sterling's been very weak, higher than expected inflation numbers will see decent upside reaction. If the inflation numbers are worse than expected, well, sure, downside reaction for sterling, but don't forget it's already sold off a just giant amount. So don't get too optimistic about any major moves lower here. Don't forget, I'll remind you, on the monthly chart, the 2010 low is this week's low. Okay, that this week's low is at 142.37, which is 5 pips above that price that we bottomed out at in 2010. Just bear in mind that level. All right, that's the UK data at 9:30. We get the ZEW economic sentiment survey coming at 10 o'clock from Germany and the Eurozone. With the German number, that's always the more important one. We're expecting it to drop back. Last month it was 16.1. We're expecting that to halve back to 8. Okay, we'll preview this nearer the time. We've got still 50 minutes till this data hits the wires. Then we get European also at the same time, the final readings for European December CPI. So we've already had the preliminary data for this, so we're not expecting any change. So 0.2 on the year and 0.9 on the core. Okay. Then into the US session, and actually from a data point of view in the US, again, it's pretty much forget about it. We've got NAHB house market index is perhaps the most interesting, but that's not particularly interesting. So not really a day for US data, although we do get the earnings season back up and running. We get Bank of America, Morgan Stanley before the opening bell, and then IBM after the close. Okay, keep an eye out for Carney. So he's talking at midday. Again, so sterling and cable may well get decent action off the CPI data at 9:30, and then Carney speaking at midday. He's speaking at Queen Mary's University. He's warming them up for us because actually Will's there tomorrow. So Carney today, DeLucy tomorrow. We're heading the bill. Well, Vast on Friday actually as well. So yeah, we're there on Friday as well. So Carney's our warm-up act. Right, that's it for now then. Look, so risk on-ish, although the bun's back to flat on the day, basically closing the gap, but certainly a positive reaction. And maybe my kind of slant on the Chinese data is perhaps the kind of main theme here in terms of how markets behave, even though the numbers are actually worse than expected. All right, guys. Enjoy the day. Thanks.